Ladies and gentlemen, welcome back to the channel. Holy moly, Tom Lee just dropped a bombshell for stock market investors. I think you need to hear this because, again, some people are always bullish, some people are always right, and Tom Lee seems to be both of those. Now, again, granted, he's been wrong at times, I've been wrong at times, but we do share a lot of the same views at this point. Now, stocks have been marching towards new all-time highs, hitting new all-time highs for the last couple of days now. Markets are starting to get a little on the overstretched side to the upside. I think it can continue for a little while, but there is going to be a consolidation period coming. And in this video, I do want to share with you kind of what I'm doing in my portfolio and how I'm getting ready for this consolidation period. Because, yeah, 3 to 4% decline on the S&P, nothing crazy, but some stocks in some areas could get hurt a little worse. Again, it sounds like I'm calling for a major correction. I'm not, but there is some ways you can position your portfolio right now to really win. Now, ladies and gentlemen, this is one of my portfolios. This is the trading community portfolio. It is up 64.25% year to date. Okay, I have a goal to grow this portfolio from its size now of a little over 75,000 to $1 million in the next 2 years off the back of the AI gold rush and my specific strategy that I am employing with members in the trading community. And what that is we are looking for stocks that could, 5 to 10x in the next 2 years, right? We're looking for big winners. Now, a lot of these big winners are small caps. Now, why that is because they're undiscovered. They don't have retail investors backing them. They don't have a lot of activity at all. And they're doing big things in AI. Okay. One of which just got a freaking buyout offer. We don't know what the actual offer is, but it's rumored to be like 3x the company's size. So a crazy buyout in those terms. The other one already went up 50%, but still down like 70% from all-time highs. It went through the whole SPAC thing like a year ago, and it's kind of messy, but it's coming out of that, okay? And wow, where do I even start with this company? It is so underlooked and underappreciated. It is ridiculous. The CEO speaks, and these videos get like 200 views on YouTube. Like, this stock, I think, could be a 50x opportunity easily in the next, even 2 years if things go well. So what we are doing is going out and finding those opportunities. 97% of small caps are garbage. 3% of them are pretty good. And I would say 1% are like your 50x opportunities, right? Maybe less than 1%. We're trying to find those big winners. It takes a lot of work. It's difficult to do so. But in doing so, I think you can take down the risk profile of just investing in small caps, right? Investing in small caps tends to outperform the S&P, but investing in just the top, 3% of small caps, you can really outperform. And that's what is driving a lot of this return in this portfolio this year. Okay, if you guys want to come trade with us live in real time, come get access to the research and come stay involved, check out that link down below in the description of this video. Again, if you're looking for 7%, 10%, 15% returns, pretty average returns, that's probably not for you. But if you're looking for 50+% returns on total portfolios, couple 100%, that could be of service to you. Okay, so check it out, link down below in the description of this video. Let's listen to what Tom Lee says about this market right now.
Research and Fundstrat Capital CIO Tom Lee, also a CNBC contributor, joins me here. Tom, good to see you.
Great to see you.
So we have this rally that's now extending probably beyond what most were positioned for, but it started in a moment of peak uncertainty.
Yes.
And even when we were in peak uncertainty, A lot of us were saying that's kind of usually forward-looking bullish. But are we now getting to a point where we have finally feasted on all of the uncertainty and now we have a lot of these blanks being filled in?
I don't. I think that it is appropriate that we are making new highs because the fundamental and the visibility is better now than it was in February at the old highs. And I think there's three levers that are going to get pulled. One we know is that the Fed didn't unleash liquidity at the April lows. So we have a Fed that's been on hold and tight. But if the information and the data comes in dovish, that's 12 to 24 months of Fed liquidity and dovishness. That hasn't happened yet. The second is that I think that there is a false argument. People are saying the multiples are stretched. The PE should be expanding because we've now had 5 stress tests that companies survived. They survived COVID, they survived the bullwhip effect, they survived the inflation surge, they survived the Fed fastest hikes, and now they survived Armageddon. If you don't have 5 more episodes, multiples will be higher 2 years from now. And the third is that I agree with anybody who says that, look, we've kind of reshaped some of the economic flows around tariffs, but that's an upside story because if it plays out better, that's an earnings surprise. So you have 3 levers that tell us that 6,200 is the market beginning to recognize we're in a better position, while $7 trillion cash is on the sidelines. And I can tell you, our clients, institutional clients, remain very skeptical. This is the most hated V-shaped rally.
I grant that given the strength of the rally, investor sentiment pretty much across the board has lagged. It's not as bullish as you would normally expect. The $7 trillion in money market funds, though, I mean, to me, that's a non sequitur. It always goes up. Unless you're at the end of an awful bear market, the money doesn't come out of money market funds. And then right now, as a percentage of total market cap, the S&P is like $60 trillion, or the U.S. market is. But it's like, what are we talking about?
Well, there's a couple things to keep in mind. One, in fact, money market balances have declined. They only started to rise really in 2022.
Right, they had a stutter step and then they went up.
If you look at margin debt, NYSE margin debt, the dollar amount absolute is still below where it was in October 2021. So you have like 4 years, it's 4 years and you're still not even higher in margin debt. And third, it really doesn't take, you don't need 60 trillion to come into the stock market to have it rise 10%. You probably need 200 billion. And I think there's a lot of high net worth money. I know there's a lot of our institutional long short macro that is shorting this rally. The long only managers are defensively positioned. They don't believe in a cyclical long. But look, if rates come down and the Fed starts easing, it's going to force people into a cyclical tilt.
In terms of the jobs number today and how it bears on all of those factors, whether it's timing of the Fed, whether it's the underlying resilience of the private sector, which maybe is still kind of in watch and see mode, how does that bear out?
Well, today would have been a day where if it was weak, then the Fed has to change its calculus, but the job market's good. So now the waiting game is, how much will inflation surge over the summer? Inflation expectations are actually coming down. So now all that we're waiting for is let it get through this CPI hump. I do think it means that once you get into September, we should really think about cuts coming. And that's what I would focus on more as an investor, that's a cutting cycle. The Fed won't just do one cut. They're going to continue cutting. ECB and the U.S., 200 basis point different in monetary policy rates. But if you take CPI year over year ex housing, which is how Europe calculates it, we're both at 1.9% today.
Yeah, we'll see if that does persist. Hey, if everyone's going to celebrate Fed going in September and December, guess what? That's what the dot plot said pretty much. So it's not as if they're two off sides, as many have made it out to be. Let's bring in Truist's Keith Lerner and Wealth Enhancement Group's Aya Yoshioka. Good to see you both. Keith, how are you kind of postured at this point market-wise? Because I know you've kind of gotten tactical around the lows. Now that we're extending to the upside, maybe in melt-up mode, how does it look?
Yeah, well, great to be with you, Mike and company. So, listen, I think this market has earned the benefit of the doubt as far as the uptrend. Yes, we have moved a lot off the lows, but the big picture, which we've talked about before, Mike, is this market's moved sideways for about 7 months. If you take out the kind of that one overshoot, which was an extreme, and then the technology sector has really been moving sideways since last July. As you look from more of a technical perspective, you're in gear right now. It's hard to be bearish when you have tech making a new high, industrials making a new high, financials making a new high. Now you're seeing this bit of a catch-up trade as well. The earning trends are positive as well. I think, listen, the biggest risk, which, there's some of the discussion, expectations have moved up as well, right? Valuations, we can argue about that a bit, have moved up. And we're seeing sentiment normalize, not extreme as well. So listen, Mike, I think we're still in a positive seasonal period as well. So I think the underlying trend is one of positive, and you have some of those catalysts like getting some clarity on the tax bill, getting some clarity as far as around interest rates, deregulation. So it's almost like some of those things we were looking for at late last year are actually coming into vogue now. So that's a positive. Are we going to have some hiccups later this year in August and September? Probably. But for now, again, we would stick with that underlying uptrend.
Tom, what's the message you're pulling from the, we're talking about new highs in industrials. Consumer cyclicals have kind of hung in there, right? So the stock market is not as if, hasn't really been leaning in the direction of we're headed for weakness in the economy.
Yes.
So what growth do you feel as if is now kind of baked into the market?
That's a great question, because you're right. I'd rather see industrials flat on their backs because the ISM's been below 50 for now 29 months. It's the longest stretch of being below 50 in its history of the survey. So I think there is pent-up spending, but the stocks have moved.
Yeah.
Consumer confidence is flat on its back. Now in 2009, it was flat on its back, and we did a study back at JP Morgan that showed the best time to own consumer cyclicals is when consumer confidence is negative. So I'd say there's less upside for both industrials and consumer cyclicals, probably more for financials and small caps, but there is this relief from businesses as we move back above 50. And I think getting this bill passed and getting the tariff behind us will push the ISM back up, and it should lead to earnings growth.
Now, I mean, the case for small caps, I mean, I feel like we kind of keep going through this anticipation cycle of when things might line up for it. You know, they've moved again. Russell 2000 hasn't been above this level except for a brief period in the fourth quarter, and then you go back to like late 2021. So what pushes it over the line?
Well, I won't blame any investor who says, fool me once,
Yeah.
fool me twice, fool me 3 times, like I'm not P.T. Barnum or whatever. But I do think it really depends on the Fed being committed to continuing its easing cycle. That's the setup we had before. And I don't blame investors for being really reluctant. But the good news is since the April lows, small caps have been outperforming, and have the banks. That's kind of the participation you want to see.
Sure. Keith, I feel like it's interesting that we're all kind of in agreement here that there's still this reserve, of a little bit of skepticism among most kind of tried and true investors and professionals out there. And yet I see some of these post-IPO moves, and you see what's happening in Robinhood and parts of crypto, and you see the daily options trading volumes. And it seems like there's a group in this market that's really pretty aggressive and highly active. So how do you reconcile those things?
Yeah, Mike, well, I think that probably suggests at some point we will have some gut checks, because sentiment, which was extremely supportive at the lows, I would say is neutral to maybe a slight negative as a whole. But also going back to like this move off the lows, 20%, we know, looking at the data, we've seen 2-month moves of 20% about 10 times since the 1950s. And a year later, you've been up every time. That's a small sample. Things could be different this time, of course. But again, I mean, the big picture is there's a kind of this mix of skepticism and then this kind of really greed factor. You see the high beta stuff outperforming as well. So again, maybe that leads to somewhat of a gut check, but sentiment more broadly to us isn't a big hindrance, overall for this market, and the flow data is mixed. So again, I would put a little bit more weight on the underlying trend. But again, I also don't want to be complacent saying we're not going to see any hiccups. It's going to be just a smooth ride forward when everyone is feeling pretty good ahead of the 4th of July here.
Yeah, absolutely. And finally, I mean, the bond market is it seemed pretty agitated for a little while. People got a little maybe oversensitive to, let's say, the 30-year going up about 5%. We're talking about still wide deficits for a few years, most likely. How does the bond market's action speak to you? And what do you, again, tell clients about the role for fixed income here?
Sure, Mike. I think in the bond market, it's tough, right? I think bonds have always been this ballast and hedge against equities, and they're not as much of a hedge, especially in a stagflationary environment. But with that said, the Bloomberg Ag Index was up 4% year to date in the first half, and it's been the best first half since 2020. So I think bonds are still doing a good job, and they're providing income, especially to the retirees that are many of our clients.
All right. Yeah, I guess playing the role that maybe they were assigned for a while here. Tom, Keith, and I thank you very much. Appreciate it. And of course, happy 4th.
That was obviously insightful. Every time Tom Lee speaks, it's insightful. I think the next 6, 12, 18, 24 months specifically is going to be an AI gold rush. Okay. I think we are at a moment that is kind of similar to the beginning of the internet without the bubble part. Okay. Now we could get a little bubble-like over the next, 2 years. I think at times some people are going to probably call it a bubble. I think there's going to be a lot of capital rushing into AI stocks as interest rates come down, as the economy holds up, as geopolitical tensions have died down, the tax bill has, been passed, which is kind of stimulative in the short term, the next couple of years. As we continue with this AI Cold War with China, I do see AI as being a top theme, really the only theme in markets. And I think it's a gold rush. And I think investors that are investing heavily into this theme right now in the right areas are going to make a lot of money. Now, again, I do think we're going to see a correctionary period, not a full-blown correction, but a little bit of a slowdown here in the next coming weeks. Okay, why is that? Well, the RSI is at 76. Last time we were overbought on the RSI was almost a year ago on July 10th, 2024. You went up 3 days in a row. You went up 0.63% on the 12th. On the 15th, you went up 0.27%. And on July 16th, 2024, you went up 0.59%. Then you fell 1.4%. Then you fell 0.77%. Then you fell 0.66%. Up a little bit, up kind of break even. Then you fell 2.3%, right? Then you fell a half of 1%. A little bit of chop, you could fall 3 to 4%. That's kind of my view coming up, because once the RSI gets into the 80s, it's only a matter of time before you see a correction. And I think that means the S&P could go up another 1 to 2% from here, but you're getting closer to that correction. Now, what I have started to do in this portfolio, one stock that I bought at the low of the crash, okay, the crash we had this year, was Robinhood, for an example. Robinhood, $100 billion company at this point. The stock went from $30 to $100. Okay. $3 billion in revenue, trading at $100 billion. Not really an AI stock. Not really. It's like a fintech name. I don't know the exact category you'd put Robinhood in, but it's not fitting the parameter of my themes for the next 2 years, which is really just AI. Okay. Can the stock go higher from here? Sure. But after a rally like this, I sold out of all of my hood position. Okay, just as for a context, because it doesn't fit my AI theme and it's up a lot quickly. Okay. So I think there's other stocks as well that kind of fit that bill that are up a lot, that are not in the AI criteria or in the AI field. Okay. Where, again, I think Robinhood can go higher from here. Let's say over the next 2 years, it goes up 50%. Great. That is a very good return for average people. Okay. But if you're looking for a 500% returner in the next 2 years, it doesn't fit the bill. I think the capital could be better spent in other areas. So that's what I'm doing in my portfolio right now with some stocks like Robinhood that have just went up a lot, 1 to 3x since April, and they're not in necessarily the AI field. And I don't think they have another, double, triple, 5x over the next 2 years. I'm getting rid of those positions right now. I'm taking the opportunity as markets have bid these stocks up to reduce exposure and reduce that risk from that perspective. Because I do think the AI stocks in a 3 to 4% correction are probably going to fall more. And I want to have cash ready to go to buy those stocks. Okay, so I do like the idea of trimming some of your non-AI stocks that are at all-time highs that have went up a lot and reallocating to more of the AI-centric theme over the next 2 years. Guys, again, this is a once-in-a-lifetime opportunity for AI. Now, all of the AI stocks that everyone already knows about, I'm not a huge fan of. I'm not a huge fan of NVIDIA. I'm not a huge fan of Dell. AMD, kind of. I could definitely, see that. The market cap's only like $150 billion. Like, I could get behind that as AMD does grow market share over time. Okay. So that's one that I could get behind that everyone knows about. But even some of your smaller AI names that everyone knows about, I'm not too interested in those either. I'm interested in the ones that nobody's talking about yet. Because whether you make money or not in a stock comes down to when you buy it. If you're early to it, if you were early to NVIDIA and you were buying that thing in 2022, you made a lot of money. Okay. If you were buying the stock at the highs this year, you probably didn't make money. Okay. When you buy a stock is very important. So again, I like Tesla. I don't know, maybe it's just me, but I think if there was ever a moment to take a little bit of additional risk, it is for AI. It is right now. That's just my thought, and that's how I'm investing my capital. If you guys want to come invest with us, every time I do due diligence on a company or invest in a new company or make a short-term trade, I send out alerts. So check out that link down below in the description of this video. You guys have a great rest of your day, and I will see you in the next one.